Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk this afternoon, we have Kevin Mahn, Chief Investment Officer of Hennion and Walsh, Dr. Preston Cherry, Founder and CEO of Concurrent FP, Christopher Gunster, Head of Fixed Income Strategies at Fidelis Capital, and Dr. Noah Weisberger, Managing Director of Institutional Advisory and Solutions at PGIM. We're here to discuss the economic, geopolitical, social, and market factors to consider for portfolio allocations in 2024. Gentlemen, it's great to have you with us. Welcome back to the Nasdaq Market Site and to Trade Talks. I'm going to kick it off with the 2023 recap. Kevin, we'll start with you and go around the table, and really what worked in 23 besides everything.
Sure. As you know, my overall macro theme for 2023 was better days ahead, and that certainly proved to be true for the markets as a whole. We saw the S&P 500 rally on a total return basis by over 26%. However, over 60% of those returns came from just 7 large cap technology stocks, and that attribution was as high as 100% as of the end of October. We also saw bonds rally. In fact, in November, municipal bonds had their best month of performance since July of 1986. We see that momentum carrying through into 2024. In fact, my macro theme for 2024 is an expansion of the rally, or a rally of the rest, if you will. We see the breadth of that rally now extending beyond those 7 technology stocks, extending beyond just municipal bonds into other asset classes as well. But only when the Fed starts to cut interest rates, which we don't believe will start to take place until the second half of 2024.
And Preston?
Yes, I mean, what didn't work? I mean, we had the softest landing ever last year. I mean, everything was working. So all factors were just going gangbusters. I think what worked is consumer spending. How much of this, dry powder does the public have in order to keep driving that consumer spending? Do we have enough of it left? I mean, it's kind of like a cash stash. Do we have enough? The people were talking about paying down debt during that time, so they have a little bit more cushion around their belts. But when that goes away, is that going to start signaling different things in 2024?
Yeah, so look, 2023 was a great year for risk assets, including fixed income. And that's great because if I go back and you think about what a horrible time 2022 was, it's very refreshing to have some positive returns. And in fact, if you look at bond market through 2023, the first 3 quarters were touch and go. There's a lot of concern about a repeat of negative returns for 2023. And then, of course, we came into the 4th quarter and saw a rally, obviously due to the change in the expectations from the Fed, the messaging from the Fed, all of that rallied fixed income. And if I look at aggregate returns, so in taxable bonds, you're looking at roughly 8.5% return for 2023 municipal bonds, up roughly 6.5%. What's interesting about those returns is a very large portion of those returns were derived from income, from coupon. We haven't seen that in a very long time. Yields right now are as the most attractive they have been since 2008. Even given the sell-off that we saw, or the reduction in yields that we saw just in the last month or so. Very attractive. That's our theme for 2024, at least for fixed income. It's a great place to be. Yields now offer both real and nominal returns we haven't seen in a very long time.
Yeah, kind of blows out that headline, 60-40 portfolios are dead. I mean, it certainly worked.
It did, and as far as going forward and looking at returns going forward, you do have that backwind from fixed income, that coupon return, that income return that we haven't seen in a very long time. And that's going to be a tailwind for fixed income.
Yep, and 60-40 was on life support in 2022, but in 2023 we saw that it's back alive and kicking again. But that really is just an arbitrary asset allocation, right? It's no more dead or alive than 70-30 or 80-20 would be, but I do see better days ahead for both bonds and stocks once the Fed starts cutting rates, inflation continues to moderate, and economic growth starts to stabilize, which should take place during the second half of next year.
And Noah?
Yeah, just to synthesize some of the thoughts around the table, to us, it's kind of the 2 asset classes together. 2022 is a difficult year. 2023 was a much better year. A lot of hand-wringing around balanced portfolios in a positive correlation world. And this is a regime change. It's a totally different environment than most of us or our younger colleagues certainly have seen. From 2000 to 2020, a world of negative correlation where stocks and bonds hedged each other, where they were naturally hedgers. And so in 2022, people really were worried about these balanced portfolios, call it 60-40, call it what you will. That wasn't the case in 2023. And as we look forward, we think there are reasons to think, some good reasons to think, that positive correlation will persist, so stocks and bonds may not be hedges for each other. At the same time, we don't think that means bonds are any less valuable as part of the portfolio. One, because they provide diversification, and two, we do think that there may be a valuation argument as well. And so, as the macro backdrop suggests that positive correlation may persist, we think there's a lot of work to be done to help people think about this new environment that they haven't seen for 20 years. But we don't think it's a negative message. We think it just needs a little bit of working through what exactly the way to think about allocation and portfolio construction in the new world.
And you know, Kevin brings up a good point, right? All of this depends on the Fed and their actions going forward. And right now, the market is very rosy about the Fed.
Yes.
A little too
Perhaps
rosy,
too rosy,
if you ask me. And so I think the market has to back up a little bit here now. We've taken some of the performance, the expected performance in 2024, we've taken it and we pushed it back into 2023. So it's going to be a little bit different when we go through 2024 here. But depending on the Fed, and it's a real concern around how many they're going to do and the dislocation between what the market expects and what the Fed expects. Fed is looking, if you look at the dots plots, 100 basis points.
Not all in one meeting, though.
Not all in one meeting, 25 basis points.
They have to spread.
The market is vacillating between 5 and 6 cuts for 2024. That has to be rectified.
Yes.
Thinking both about the monetary policy side of it, but also the fiscal policy side of it, I think from our perspective, both of these factors, the clearest way to see their impact on the market has been through rates volatility. So equity volatility looks very relaxed. We're back at pre-COVID levels, let's call it, but rates volatility seems to be reflecting both fiscal policy, concerns about the sustainability of debt, maybe some uncertainty about what the Fed's rule-setting regime will be. And in our view, this policy uncertainty, both on the fiscal side and the policy side, have historical antecedents going back to the 70s and 80s when positive stock-bond correlation ruled the roost. And we think those are really important factors to consider today on a forward basis. Like, why could positive stock-bond correlation persist? Well, some of these things, both in terms of monetary policy uncertainty, but also in terms of the fiscal sustainability issue, and both of those seem to be pushing rate volatility higher.
And you want to bring confidence to the market. I mean, we just came out of all these volatility and uncertainty. So now that we have these shocks from interest rates going up so high, what does it mean to go back and start entering shocks again with massive rate cuts at like maybe 100 basis points? They have to smooth those over in order to get some smooth uncertainty, bring back confidence. And if we can do that, then the companies themselves can predict, forecast better, and even the consumers, they can say, listen, we have a little bit of stability, I feel better, I have confidence. You know, the markets, they run on feeling.
I truly think the Fed is not going to make the mistake that we saw when they pulled back rates too quick and too fast. I mean, history is certainly going to serve as a guide there. But speaking of pre-COVID levels, do you think COVID distortions are out of the market at this point, Kevin?
I don't think they're necessarily out of the market, and I think one important thing for all investors to remember is to try and not do what we're doing around this table right now, and that's play the Fed guessing game, right? We don't have a crystal ball. The Fed certainly doesn't have a crystal ball. Based upon their dot plot chart released after their December meeting, they're forecasting roughly 75 basis points in cuts next year, another 100 basis points in cuts in 2025, and yet another 75 basis points in cuts in 2026. So if I'm doing my math right, that's about 2.5% lower. So I think we could all agree that interest rates will most likely be lower over the next 3 years. I don't know the magnitude, I don't know what they're going to do and when, but we all agree that they're going to be lower over the next 3 years.
I agree,
right?
and I think the risk to that really is inflation if that comes back up. If you look at the trajectory of inflation that we've just experienced over the last couple of years, and you compare that to the 1970s, it's spot on. And as you know, it came down, it came right back up. We are at that trough now, and the risk to the market is that inflation comes back again, causing interest rates to move a little bit higher.
And I think just to reference the COVID analogy, like I think in two respects, I think we're still living through some of the COVID hangover. One, in terms of the inflation run up and decline, probably, arguably, you can estimate that that's a large part driven by the supply side of the economy. I think the Fed puts about 2/3 of the run up and some of the decline all on supply chain pressures increasing and then easing. And again, the supply shocks also make you think back to that 70s, 80s period, a real different market environment than the demand-driven maybe 2000s with China coming online and so on. And so the COVID hangover of supply still driving this economy has a negative ramification in supply chain disruptions. But just to riff off what you were saying before about the leadership of the stock market being so narrow, maybe there's like an optimistic cloud, also there's silver lining in the cloud of productivity-driven technology, AI, and so on, which would also be a supply shock, also a new paradigm for this market, and that would be like a new player in the game, but one that we think would also lead to positive stock-bond correlation, but because of positive supply shocks versus these supply chain disruptions that we're now first just getting rid of.
And I think also too, I think companies, since they were adjusting to all of the interest rate shocks, they held a couple of things steady. I mean, they were retaining talent. I mean, so employment numbers haven't moved all that much. So people are not feeling the pain, and the companies are saying, I need to retain talent in order to continue to buoy or boost, our revenues and our projections. So they really didn't lay off that much, but they are signaling a little bit of belt tightening. You see in these little spot areas of layoffs happening, and so again, with the interest rates smoothing things out, we can't have too many other shocks. And I think the numbers that dip in unemployment, if that ever happens, then we won't have such soft landings going forward.
Right. Well, we know betting against the consumer has been a losing bet, right? We have, over $1 trillion in credit card debt.
Yep.
Student loan payments are coming back online. Certainly, savings have been dwindling. I mean, how much longer can the consumer perform? I mean, I feel like we've been asking this question.
That's the biggest risk here, right? We have over $1 trillion in credit card debt. Right now, according to LendingTree, average credit card balances are at 24.5%, the highest on record. We know that auto loan payments are at their highest in terms of delinquencies in the last 3 decades. Early delinquencies, our credit card payments, just hit their highest rate in the last decade, according to the New York Fed. How much longer can that continue? So I know I'm fast forwarding a little bit here, but the biggest risk that I see this year is that the Fed stays too high for too long. How much longer can they keep rates at these levels? Because not only does that have an impact on the debt servicing of the U.S. consumer, but also on the U.S. government. A U.S. government that in all likelihood will experience its 3rd downgrade in 2024, which is only going to increase the cost of issuing new debt. So that's what I see as the biggest risk in 2024. I don't think it's going to come to fruition. I think the Fed does step up towards the end of the 2nd quarter, early 3rd quarter, and start cutting interest rates to help prevent this economic slowdown that they're forecasting from going into recessionary territories. But if they stay too high for too long, that could cause a dislocation.
Yeah, so you asked about the consumer as well, right? Consumers are feeling good. Most folks have a mortgage that is incredibly low, and when you feel good, even if it's on paper, you're going to continue to spend. And so that's going to continue. I don't think all the COVID, if you want to group that into COVID excesses, you can, because it's those low mortgage rates that are derived from the COVID response. Now, that being said, Kevin brings up an excellent point about debt and debt service. We're at $34 billion in terms of Treasury debt. That's going to only increase. Most folks are concerned about that, and you should be. The proper way to look at that is the GDP, debt to GDP ratios. If GDP can grow as fast as the debt, we don't have an increasing problem. But if GDP doesn't grow as fast as the debt, then we have a problem. Expectations right now, if it's a soft landing, they'll grow in parallel. But to the extent that we do get a recession, GDP drops and debt does not, continues to increase, then we have a problem. Moody's will downgrade the U.S. It will cause volatility in the marketplace, so expect that.
And you look at the summary of economic projections that the Fed released after the December meeting, GDP growth forecast, not by me, not by any of us, by the Fed, 1.4% next year, and staying below 2% all the way through the end of 2026. If we keep adding to the debt at the levels we are right now, GDP stays below 2%, that's not a good formula.
And that's another form of the COVID overhang, right? So the fiscal spending we saw. So again, glass half full, glass half empty, manufacturing, construction put in place, right? Huge numbers there, direct evidence directly from kind of some of the fiscal policies we've seen focused on deepening the capital stock. Maybe optimistically that's a productivity shock going forward, helping to boost labor productivity. But at the same time, 120% debt to GDP projected to go to 130%. And I think the way we've been thinking about this sustainability issue is nominal interest rates versus nominal growth, but really nominal what the government is paying versus what you see on your screens. Because just like a consumer or a homeowner, if you locked in and the government's been able to lock in, and I think we're getting very close as like the CBO, again, it's not my forecast, someone else's forecast.
Right.
The Congressional Budget Office has the effective interest rate going around 3%. and nominal growth around 3%. That doesn't give you a lot of wiggle room, right? A couple of quarters of recessionary growth, and all of a sudden, whatever sustainability concerns you had flash red versus just kind of.
So add this to the volatility mix as well, right? We're in an election year. Moody's is going to downgrade.
Right.
Debt service is going to increase. Volatility is coming back.
And I think the new norm is just how do we efficiently manage our debt? Because to your point, it's like we are in an election year. And so we don't know what type of policy is going to trigger how we're managing the debt. I think that's a real danger there. It's like, okay, well, now when we change parties or change election cycles, okay, is there a threat of not managing our debt so well? So that's a policy threat right there. So I think the unknown unknowns, I think who said that? I think somebody said that.
Right.
But the unknown unknowns, I think, are the greatest danger.
It doesn't even
I
feel
wish
like
I knew what those unknown unknowns
Right,
were.
right.
it doesn't even feel like managing the deficit is even a talking point.
Yeah.
Right. I mean, I haven't heard anyone discuss like how we're going to potentially manage the deficit, and I would agree with you, Chris. I think that's the biggest risk out there.
It is. It is. And you'll hear more about it. We're in an election year. It's going to be a hot topic. That catalyst, again, I'm going to repeat myself on this move, that's going to be a catalyst to bring all of that to the forefront.
Let's go around the table here then, Kevin, starting with you. How are you thinking about positioning for 2024? Should investors be as worried as perhaps we are talking about, an election year, savings dwindling,
Geopolitical risk overseas.
Fiscal risk? Yeah.
Yeah, I think it's just a reminder of the benefits of diversification. Sometimes that gets lost during market pullbacks and market rallies as well. But we do see a couple of areas that stand to benefit from an economic slowdown, which will ultimately meet declining interest rates. Those areas include, on the slowdown front, industrials. We really like aerospace and defense stocks in this environment. Defense spending alone is forecasted to increase by nearly 50% to $1.1 trillion over the next decade. And you know the names that stand to benefit from that, whether it's going to be a Lockheed Martin, a Northrop Grumman, or even a Howmet Aerospace. Beyond that, we also like names that are in the technology space, not necessarily AI. I know we all want to talk about AI right now, and I'm going to stay away from AI, at least for this segment. But we like crypto, not crypto rather, but cybersecurity. What's been lost in the AI race is the critical importance of cybersecurity, the glue that holds the technology puzzle together. We like names such as Fortinet in that space, or even CrowdSpace. We think those are areas that provide upside value. And then the investment grade municipal bonds on the fixed income side, and preferred securities. Yeah. Historically, one of the best performing fixed income asset classes at the end of rate hike cycles. So there are opportunities that are available for investors as rates start to decline and economic growth starts to moderate in both stocks and bonds. But diversification will be key in 2024 because volatility is not behind us.
And Chris, from the fixed income perspective, how are you allocating?
Yeah, so you want to remain higher in quality, frankly, because there are some volatility coming. There's some concerns out there. I agree with you. The investment grade should be where you should be. Municipals had a great rally. I would, however, take a step back, and if you look at corporate bonds on an after-tax basis, some of it makes sense relative to munis. Now, munis, we're in a seasonal area in which munis are going to continue to rally, okay? But if you're a high taxpayer, take a step back. Look at corporate bonds. For a similar municipal bond, you might find some value there.
And Preston?
Yeah, I think the Magnificent Seven are still going to get some attention. I mean, they've been just doing so well. But that said, it's a little bit of confidence. I mean, they do make up 30% of the S&P 500, and the interest rate environment is such that it's predictable a little bit, meaning that it should be smooth a little bit, so growth areas can still have some higher highs, but I think they'll be a little lower. I also think the fundamentals are coming back into the portfolio. So there's areas like small caps that are doing fairly well, and then also too international. I mean, places like the India, Middle East. I mean, they have higher GDP prospects than we do. So when those fundamentals start coming back into the portfolio, it goes back to the point. 60-40 is not dead.
And Noah?
Yeah, I would just, that's a great segue. I mean, and to amplify what you said about diversification, I think given these uncertainties, the message we're going out to clients with is that diversification remains important. Bonds remain an important part of that story. Even in a positive stock bond correlation world, we think the portfolio actually does a little bit better historically in positive environments than in negative, but at a slightly higher volatility, because you need to be compensated for the fact that these assets don't hedge each other. But that balanced portfolio is still kind of a long-term vehicle that you want to be thinking about. And one extra point or extra reason to think about bonds in the current environment is the valuation gap between stocks and bonds. Looks like you could see a period of, on a risk-adjusted basis, bond outperformance going forward. So we really telling clients that, despite a lot of loud headlines to the contrary, bonds really remain an important part of a balanced portfolio, even if we're in a new long-term regime that people haven't experienced yet.
Bonds are sexy these days.
Yes, they are. All right, gentlemen, appreciate the insight. Thanks for joining us on
pleasure.
Trade Talks, and thanks for joining me from the Nasdaq Market site. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.